let's talk about the 2008 financial crisis. You probably have a pretty clear story in your head about what went down, right? Risky mortgages, toxic assets, the whole global economy just teetering on the brink. It's a story we've heard over and over. But what if a really crucial part of that story isn't quite right? We're going to dig into that because some fascinating research suggests the real story is way more surprising than the one we all think we know. And yeah, this quote right here, this is basically Exhibit A of the popular story. The idea that these super risky subprime mortgages were all bundled up, slapped with a super safe AAA rating, and then sold off. You know, this narrative became the explanation. It's what we saw in the movies, it's what we read about for years. So that's the exact question a group of researchers decided to ask. They weren't just happy with the headlines. They wanted to go back in time, way after all the dust had settled, and do something that sounds really simple but was actually massive. Just follow the money. They wanted to find out what these so-called toxic assets actually paid out at the end of the day. To pull this off, they basically performed a financial autopsy. You can think of it like they treated the entire pre-crisis mortgage bond market like this giant, complicated crime scene. The goal wasn't to point fingers or assign blame, but just to piece together what really happened using cold, hard numbers, looking at the data, not the drama. And the sheer scale of this project was just mind-boggling. They built a database completely from scratch, tracking pretty much every single one of these mortgage-backed securities. I mean, look at these numbers. We're talking over 8,600 deals, which held more than 143,000 individual bonds, worth a grand total of almost $6 trillion. This is, without a doubt, the most complete picture we have ever had. So, here we are, the big question: what did they actually discover when they finally put all those puzzle pieces together? Well, my friends, this is where the story we all thought we knew starts to get really, really weird. All right, the very first surprise pops up when you just look at the credit ratings themselves. Remember, the story goes that this whole market was just flooded with junk that was dressed up to look like treasure. But the data? Well, the data tells a totally different story. Get this, almost 87%. The huge, overwhelming majority of these securities were given the best possible rating, AAA. The stuff that was officially labeled as riskier, that was actually just a tiny little slice of the whole pie.
Okay. I can hear you thinking it. So what? A rating is just a sticker some agency put on a box. Who cares? What about the money? Did they all crash and burn like we were told? And you're right. That is the real question. Let's look at the actual losses.
And boom, here's the number that just blows a hole in the old narrative. On average, these supposedly catastrophic, world-ending AAA securities lost just 2.2%. Now look, for an investment that's supposed to be basically risk-free, that is not good at all. But it is a million miles away from the total systemic wipeout we all have in our heads.
But you need to hang on because it gets even crazier. When the researchers started to separate the bonds based on what kind of mortgages were actually inside them, they stumbled on the biggest plot twist of the entire story. This is the part that just flips everything upside down.
All right, so just a super quick refresher so we're all on the same page. Prime loans, they're for borrowers with fantastic credit. Altea is kind of the middle ground. And then there's subprime, the ones we've all heard about a million times, which were for borrowers with lower credit scores and considered the riskiest of the bunch. So let's check out this table. This shows the average losses for only the AAA-rated stuff. Now look closely. The Altea bonds, that middle group, they actually did the worst, losing 6.5%. Even the supposedly super safe prime mortgages lost 1.3%. But then you look at the subprime bonds, the ones at the absolute heart of the crisis narrative. They lost only 0.4%. Let that just sink in for a second. The financial products that became the public enemy number one of the 2008 crisis, the infamous AAA-rated subprime bonds, actually turned out to be the best performing category in this entire massive analysis. It is the literal opposite of what almost all of us have believed for more than a decade. So what on earth is going on here? If the main villain of the story turns out to be this shaky, we have to ask ourselves, what really happened? Yeah, this is the next logical question, right? The financial crisis was obviously devastating and very real. So if the average AAA bond didn't get totally wiped out, where did all that financial pain and damage actually come from? And the answer is right here in this chart. The damage wasn't like a gentle rain that fell on everybody equally. It was much more like a series of lightning strikes. As you can see, about 65% of the securities had tiny losses, if they lost anything at all. But then you look at the other end. A smaller group, about 20%, were almost completely vaporized. It wasn't that everything went a little bit bad. It was that most bonds were actually okay, while a select few were an absolute total disaster. So, to wrap up what this massive financial autopsy showed us, 1, the simple story we've been telling about universally toxic assets, it seems to be incomplete, at best. 2, the huge majority of these AAA bonds did not blow up. 3, the supposed villain of the whole saga, the AAA subprime bond, was actually the safest of the bunch. And 4, the real damage came from a few, super concentrated failures, not a widespread collapse. And this all leaves us with a really fascinating final thought. The way we understand these huge events completely shapes how we prepare for the future. So if the common story about 2008 isn't the full picture, it really makes you wonder, what other important details are still hiding in the data? And what could they teach us about how these unbelievably complex systems really work?